Want to save for your child's education tax-free, but not sure whether to use a 529 plan or a Coverdell? One gives you more flexibility, while the other allows for higher contributions. Which one is right for you? Let's break it down so you can make the smartest choice for your family's future. I am Kristen Gunderson with Gunderson CFO and Bookkeeping. I am a member of Mark J. Kohler's Main Street Tax Advisors. So this is where this information is coming from, and I'm just relaying it to my my fan base and my clients. Okay, so ultimately there's three account options. There's actually the Coverdell, there's the Roth, and the 529. I'm not going to talk about the Roth today because I've talked about the Roth in other videos and talked about paying your children so that they can invest in a Roth. So that's covered in other videos. We'll make sure to post the link below. But the other thing is that with a Roth, you have to have earned income. So if you don't have a business, your child's not going to be able to work for you and not have earned income. So he or she is not going to be able to participate in a Roth IRA. So that's why this video is just on the 529 versus the Coverdell. So you don't have to have a business. The kids do not have to be working. You can just contribute to a college savings plan for them for college. So why is the 529 so popular? The 529 is popular because of two words. Can you guess what they are? Wall Street. Yep. The financial industry gets to trade and bury their ridiculous expensive fees in the 529 accounts. Wall Street has really lobbied Congress to make them more attractive to people. Most people I talk to have never even heard of a Coverdell. So like, what's a Coverdell? They've only heard of a 529. So you got to think, why is that? Why is the 529 so much more popular? And it's because they've literally have lobbied Congress to make them very attractive. They've made them very popular. One of the things is they allow for massive contributions compared to the Coverdell. So you can contribute $80,000 in a 529 versus $2,000 in a Coverdell. There's no income limitations on the donors opening up the accounts, and they have flexible options in making changes to the beneficiaries. However, so it sounds really, really good. However, other than that, they're absolutely terrible. And the reason why, besides of the high fees, like you basically put in, oh, my child is 2 years old, so they go into this age based off of how many years there's an age thing, and based off of the age, like, oh, they have higher risk or lower risk. Like if you have a 16-year-old, they're going to have lower risk, so they're not going to make as much money while you're putting that money in there because there's only a couple years before they supposedly need it. And you don't really get to say what you want to have your 529 invested in. It's kind of whatever Wall Street chooses in that age group is what it gets to go in. So that's why I'm very against 529. And granted, I have three 529s for my three children. And I wish I didn't. Like I wish I would have learned this earlier and done stuff differently with my children. But now I just know. And I've actually skipped the Coverdells and gone straight to Roths with my children. But if I did not have a business and did not have that option, I would do the Coverdell. So why the Coverdell? Wall Street is not in your business and you can self-direct the investments. So you get all of the awesome contribution benefits of a 529 then, right? You're wrong. It's Wall Street. The reason's Wall Street. So they have, again, they've lobbied and lobbied and lobbied. So there's a lot of stuff that isn't beneficial in a Coverdell, and I'll go through that next, but I would rather have the Coverdell than the 529 for even my kids. And I just flat up straight, honestly, I've stopped putting money into the 529s for my children. Like that's how much against the 529s I am right now. All right, so Coverdell basics. You still build a tax-free account like a 529. It grows tax-free and comes out tax-free for the same qualified education expenses like a 529. The same rules if you pull out money for non-qualified expenses. I'll go more into that in a little bit. And then the beneficiaries do not have to be related to the depositor. So what are the problems with Coverdale's then? So the main problem is that you can only put $2,000 in per beneficiary per year from all sources, right? And the beneficiaries must be under age 18 when the Coverdale is opened on their behalf. Along with that, contributions of the $2,000 per year can only be made until the date of their 18th birthday, not the year they turn 18. So those are some downers. So like if you have a 16 or 17-year-old, you could only get like $14,000 or 2,000 a year, so that'd be $4,000 a year until they turn 18. If they're younger, say they're one or two, I mean, then you'd be able to do $2,000 a year up until they turn 18. Another problem is that donors cannot make more than $110,000 if they're single, or $220,000 if they're filing married file joint of their adjusted gross income. However, there's always a way around things. So I will just talk about that later. That's the backdoor. It's a backdoor strategy. So I'll cover that in a little bit. So then I get asked a question: what happens with leftover Coverdale money? Say the child doesn't use all the money that's in there. Say they don't go to college, and you have money left over in their Coverdale account. What happens? So the first thing is that we can change the beneficiary to another family member. Say you have a daughter or a son, and they're like 20, 29 years old now, and they have a child of their own, and they didn't use all that money. They can literally change the beneficiary to their children now, to that new 1 or 2, 3 year old that they have, right? However, this must be done before the beneficiary turns 30. That's why I said, like, if they're 28 or 29, like, that's when we're like, okay, that's the time that we need to consider who are we going to transfer this money to, because once they turn 30, like, it's SOL. Like, they will just get that as a distribution, and they'll get taxed on the earnings. The amount that they put in is not taxable because it's after tax money, but any earnings they had on the money will be taxable. So main thing is we can change the beneficiary. Or guess what? Again, Wall Street, like, you can roll that money into a 529 plan. Isn't that crazy? You cannot roll a 529 plan into a Coverdale though. I've tried. Um, it makes me so mad. But anyways, um, and then another thing is they also put into law January 1st of 2024 that if you have money in a 529 plan, you can roll it to a Roth. I tried that also with my oldest who didn't use her money. Well, guess what? It has to be in the 529 plan for 15 years before you can transfer it out into a Roth. And you can only transfer the $7,000 a year that you can put into a Roth from that 529 plan. So it's not as good as they made it seem to be. Anyways, like I said before, you can actually pull the money out. Your contributions will never be taxed or penalized since you made it with after tax dollars. Any earnings on your investments will be subject to income tax and that 10% tax penalty. So I want to talk a little bit about the backdoor Coverdale strategy. Okay, so let's talk about 529. I've talked a lot about Coverdale, and I'll talk a little bit more about Coverdale at the end of this video on what we can do, like why I like them so much to make more money, because we're in control of the money, not Wall Street. It's not going up, then down, up and down. It's not based off of what the market's doing. Like, we have control. That's what self-directing is. We have control on where that money is going. We're investing in things that we know and we've done the due diligence on in order to hopefully have more control of the outcomes of where we're putting that money. Okay, So a 529 college savings plan works much like a Roth IRA or a Roth 401k by investing your after-tax contributions into mutual funds, ETFs, and other similar investments. Basically, anything that you can buy on Wall Street is something that your 529 could get invested in. Contributions are not deductible from federal income taxes. However, you may also qualify for a state tax benefit depending on where you live. I live in Texas. We don't have state taxes, so we have no benefits. So, this is something like if you're in a different state that has state income taxes, you'll really want to research this to find out what deductions you get for contributing to a 529. And there are no annual 529 plan contribution limits. However, contributions in excess of the annual gift tax exclusion, which is $19,000 in 2025, will count against your lifetime estate and gift tax exemption, which in this year in 2025 happens to be 13.99 million. And just for you know, that's what the numbers are for 2025. It's February. We have new administration in office. I don't know if those numbers will get changed this year, or they could possibly change going up or down in future years depending on which administration is in an office and what they want to do. But as for right now, those are the limits. So each state also has an aggregate contribution limit for 529 plans, which ranges anywhere from 235,000 to 555,000. So again, you'll want to research your state and find out what that contribution limit is. Assets that are held in a 529 plan receive favorable treatment on the free application for federal student aid. That's the FAFSA form. And distributions are not reported. So again, this is just another benefit that the 529 plan has that they don't have for the Coverdell. So in recent years, the IRS has expanded the definition of qualified education expenses beyond the traditional college costs. So it now includes K through 12 expenses, but there is a $10,000 annual limit on qualified K through 12 withdrawals. Another thing is the IRS has expanded education expenses to allow for student loan payments, and there's a $10,000 lifetime limit on student loans. And I don't quite get this one because if you have the 529, why don't you just use the 529 to pay for the kids' college instead of then having to pay for student loans? It doesn't really make sense to me, but whatever. There is a withdrawal penalty if you use a 529 plan distribution on non qualified expenses. So if you take that money out and use it to buy a car or I don't know, a swimming pool, something that's not education related, you have to pay the income tax and a 529 withdrawal penalty of 10% on the earnings portion. And then last thing is students can choose to attend a public or private college or university in any state, regardless of the state in which the account was opened, as long as the institution meets the qualified criteria, which basically, if you can fill out the FAFSA form for them, it's a qualifying institution. So, what are qualified education expenses? And this is for the 529 or the Coverdell, it's across the board. So, obviously, your tuition and fees at Title IV. And like I said before, if you can fill out a FAFSA and get financial aid for the university, this counts as a college or university with a Title IV where the tuition and fees are qualified education expenses. What is not included is if you have business training courses or private education institutions, this is not a qualified education expense. So, some more things that are covered are books and material, room and board, as long as the student is enrolled at least half time. If you need internet access or any special needs equipment for students attending a college, university, or other eligible post secondary education institution, that is covered. And it's also penalty free from Roth earnings. You must pay the income tax even if it is a qualified education expense. So, what are non qualified 529 plan expenses? They are the college application and any testing fees you have to pay for. There are any transportation costs, like say your kid's going to a different state, and that road trip or that plane ticket, that won't be covered. Any health insurance, that's not covered. Any extracurricular activities, say they're in sports or in the band, or they want to take a pickleball club or something like that, that would not be included. And any expense that is not considered a qualified education expense, like I threw out the word pool or car earlier, obviously those are big no's on, it's not for education. So we already talked about what happens if you have a leftover money in the Coverdale. So what happens if we have leftover 529 money? So again, we can change the beneficiary to another family member. Beneficiary changes are not treated as a distribution when the new beneficiary is a member of the family of the current beneficiary and can be made at any time. So who does this include? It includes like your spouse, your son, daughter, stepchild, foster child, adopted child, or grandchild, also siblings or step siblings, and some other in law who you would probably never give money to. Okay, so you can also make yourself the beneficiary and go back to school. And the last thing is you could pull that money out. Again, your contributions will never be taxed or penalized since they were made with after tax money. It's only the earnings that you made while it was in that account on your investment. Those will be subject to a 10% penalty. Just some final takeaways before I talk with you and show you something really cool. I want you to know that you need to put your oxygen mask on first. I have people who are always putting money towards their kids' 529s. I'm trying to get them into Coverdales now if they want to do some self-directing. Um, but they're investing in them first. Well, I want to tell you that you're going to get old and you're going to want to retire someday. You may not want to have to work at Walmart as a Walmart greeter for the rest of your life because you can't afford to put food on your table. So I want you to take care of yourself first. Your kids are young, they're going to grow up. And if they have to work their way through school, it's okay. If they have to take out scholarships, it's okay. Like, have your kid actively work in their junior and senior year at finding scholarships to put them through school. That's their full-time job after school, like have them work on scholarships. And if for some reason they need to take out a loan, don't let them take out a loan that's more than 1 year of the average salary of whatever degree they're going for. Like if they're going for a doctor, I don't know what a doctor makes, maybe 100,000 a year. Like don't whatever that first year is that they will make, don't let them take out more than a student loan to get them through. Otherwise, have them look at different colleges. They don't have to go to Harvard. They don't have to go to the best college. Like they can go to a community college and start working on that stuff. I know at my son's school, he's going to begin like 39 hours of dual credit college classes before he graduates high school. These are all options out there. So be creative. Also, I do not want you to mortgage your house or to pull money out of your retirement for your kid to go to college. Let them figure it out. Not everyone has to go to college. There's other options out there. I want to tell you to make sure that you're fully funding your Roth IRA. This year it's $7,000. Make sure that you're at least putting $7,000 into your Roth IRA every single year. We just played with some of the numbers because I did this training for my staff before this, and um, I have a young lady who's 25, so we figured she has 35 years till she retires. If she just were to put 30 or the $7,000 a year away into her retirement, I think at a 6% interest rate, I think we calculate she have like $787,000 in her Roth IRA by the time she retires. We did it for someone who has, say, 20 years left, and that would be about $380,000 that she would have added to her retirement if she can only put away the $7,000 a year. So you can go to those investing calculators and put in the numbers yourself. You can put in the starting number, what you have now, or if you're at zero, like, and just take a look at that. It's really cool to see. So again, make sure you're putting money into your own retirement before you're putting into your kids, and have a completely separate savings plan for your kids' college. Um, if you have family members, say rich grandparents or whatever, who want to be able to put money into your children's education, have them put money into the 529. You put into the Coverdale first. And then if there's extra money, then you can do the 529. They can be used together. Like if you fully fund the Coverdale, then go to the 529 if you have extra money that you want to put aside each year for the kids. Also know the state benefits that you're at and with the where your kids are in high school, to get college credits and grants. And then any leftover 529 funds can be moved to a Roth if the rules are met. Okay, so I'm going to share the screen right now. So this is bringing it all together. So this is a trifecta. And again, I've learned this from Mark J. Kohler. I mentioned his name at the beginning of this training, and he's taught us the trifecta. So everything down at the very bottom, this is where your 1040 is, and everything flows down to your 1040. Everything on the left side of this black line, this is your butt working for your money. Everything on the right side is your assets are working for your money, right? It's passive income. So again, this is kind of a diagram like if you were to have your own business and if you could pay your kids and then can fund the 520 or fund their Roth also. But these red boxes here, like you'll see, we have crappy investment accounts in a 529. But then we have like, say our 401k, we have a Roth, maybe our kids have a Roth, and then we have a Coverdell. And what we can do is if we are self-directing our accounts, so self-directing, this is where we can have a small business note. We can invest in real estate. We can invest in crypto. These are ways that we can control. We're investing in things that we know, and that we're really good at, and that we really know. Like, okay, this is a really good. We'll have a really good return on investment instead of maybe the 5% that we're getting with our 529. We can control the outcome. We can merge these red boxes together, not the 529, but the 401k if it's a self-directed 401k, your Roth, a Coverdell. And if we have like 3 kids and they all have a Coverdell, we can merge them all into this new company LLC and merge all that money together. And then if there's enough money there, we could take that money and we can invest in real estate. Say there's um a rental property that you want to buy. Rental properties, like I'd want to do the numbers on it too, but if it's a really good deal, all that money, that monthly revenue, I mean, some rental houses are going for like 2 grand a month now, $1,000 a month, $900 a month. That $900 will be coming back into that company, and then it gets dispersed back uh proportionately to the correct account. So say there's $100,000 total between the 401k, Roth, and Coverdell. Well, 2% of that is the Coverdell, so 2% would go back to the Coverdell. That's a way to be growing that money a lot quicker than just relying on whatever Wall Street's doing, right? The market goes up or down. We know that's a consistent, say $1,000 a month that's going into that rental property. And then say if we've had it for say 15 years and now it's time for the kid to go to college, we could go ahead and sell that rental property. So we bought it for 100 grand and it's worth 200 grand now. Did you just see where we had $100,000 profit and now that percentage of whatever was originally in that Coverdale is going back to there, and we've just grown that account a lot faster and steadier with all ups than the stock market going like this, right? So that's just some ways that we can grow that account. But if you wanted to invest in crypto, private equity, there's a lot of things that you can invest in when you're self-directing. I have videos on that also. The other thing that a lot of rich people do is once their kid goes to college, they will go ahead and buy a rental property in whatever college town your kid is going to college at. You can pay your kid to manage the rental property while they're living there. And um, that money, basically what you're making monthly on that rental property, it could go back into like the 529, or not the 529. Sorry, erase that part. The the monthly rents that are coming in from that duplex or apartment building that you bought, it could basically fund your child's education that way too, with all the revenue that's coming in from that rental property. So that's what a lot of rich people do, is they will build and build and build their self-directed accounts, and then they will go ahead, buy an apartment complex where their child is going, and then the money that's coming in again will help pay for the child's education. But that's how the rich do it. So those are just some options for you and things to be thinking about what you can do with a self-directed Coverdell account versus a 529. Ultimately, we can use them together to help get your child to school. All right. I hope that was helpful. If you have any questions, please go ahead and book a discovery call. We would love for you to subscribe to this video, share it out, put comments. We would love all that. Thank you.